So recently, there has been a piece of news that a lot of people are talking about. The UK construction sector has now been in decline for 14 months in a row, and this is actually the longest stretch since the 2008 financial crisis. And now, when people hear about this, the first reaction is, okay, does that mean the property market is weak or our prices are going to fall? But actually, this is not what the data is telling us. Let's break this down into a very simple way. The data comes from something called Construction PMI, published by S&P Global. They basically ask construction companies a lot of questions such as, are you getting new work? Are you starting new projects? Are you hiring people? And they turn all this data into one number. If the number is above 50, the industry is growing. If the number is below 50, it is shrinking. For the past 14 months, it has been around 45 to 49 for UK construction sector. So this is not a crash, it is a slow, continuous decline. And very importantly, this started before all the recent political tensions. So what's really happening? The UK property market is not slowing because people don't want to buy. It's slowing because developers are building less. And this is something we see actually very clearly on the ground in London because we speak to developers almost every day. Developers are buying much less land, fewer projects are launching, and many are simply waiting. So why the UK developers now are holding back? First, interest rate. Property development relies heavily on borrowing. When interest rates go up, projects that made sense a couple years ago now do not work anymore. Now the decision becomes very simple, just don't build. Second, construction costs. Since COVID, construction costs have increased a lot. Material, labor, energy. But the key point is these costs did not come back down, so developers are now working with permanently higher cost base. Third, we need to look at energy and geopolitics. Construction is very sensitive to energy. Steel, cement, and transportation, and many other elements all depends on it. Now, layer on global events, the Russia-Ukraine conflict, and more recently, tensions in the Middle East. Energy prices are unstable. So developers cannot confidently price future costs. And you cannot price your costs, you don't take the risk, you wait. And on top of that, it's also about confidence. Right now, interest rates are unclear. Energy is unstable. Global risk is rising. So capital become cautious, of course. Now, this creates something very important, a time lag. Property development doesn't impact the market immediately. There is usually a 2 to 5 years delay. So what we are seeing today, fewer projects, fewer starts, will later translate into fewer completed houses. And here is the real issue. The UK already has a very severe housing shortage. This is actually not new. For more than 10 years, the UK needs around 300,000 homes per year, but it consistently delivers much less. London is even more constrained. It needs about 65,000 homes per year, but often delivery is just about half. Every government says they are going to fix this, but none has. And now we are making this problem even worse. The shortage already exists, demand is still there, but supply is falling further. At the same time, London's population continues to grow, and in period of global uncertainty, money and people tend to move towards London, not away from it. Now, of course, we also have to be realistic. There are discussions right now about risks in global credit markets, especially around private credit and rising energy prices linked to Middle East tensions. And if these risks develop into broader financial stress, you could see short-term pressure across many asset classes, including property. But historically, London is not a market that collapses easily. Even in more difficult cycles, it tends to adjust in short term and then recover because the underlying demand and supply imbalance remains. So the real question is not whether risk exists, it's whether you understand how that risk actually affects the London market. So what does this all mean for London property market? First, prices. This is not a market facing oversupply. This is a market where supply is getting tighter, tends to support prices and over time create upward pressure. Second, rent. If people cannot buy, they will have to rent. And if there are fewer homes available, rents will definitely go up. Third, existing properties. With fewer new developments, existing homes will become more popular and secondary market will definitely become stronger. So if you are an investor, what should you focus on? Remember, London is no longer a market where everything works. You need to focus on real demand, strong locations, properties that are easy to rent and easy to resell. In today's world, with all the geopolitical uncertainty, London actually remains a very attractive destination because it is stable, it is transparent, and globally attractive. And at the same time, prices haven't moved much in recent years because of Brexit, COVID, inflation, and many reasons you saw on the news. So today, you are not entering at the peak of the market, you are actually entering at a very reasonable level. So if you are looking at London property, you are not sure how to approach it, feel free to reach out because we work across both new development and resale, and we cover rental as well. More importantly, we will help you think through the full investment strategy instead of just the purchase.